Hello everyone and welcome back to the channel. Today we're going to talk about how you could build a property portfolio step by step. So this video is going to show you the exact strategies, the framework or the steps that you need to follow to build a portfolio over the long term. So to illustrate this, I'm going to use a couple who has a combined income of $180,000 and how they're building a portfolio to generate passive income over the long term. Hi, for those of you who don't know me, my name is Jathu. I'm a buyer's agent for property investors and I buy properties all around the country using a data-driven approach. So if you want to work with me, go to my website propertyframeworkbuyersagency.com.au and book a session with me there. Now, what are we going to cover in this video? Like I said, we're going to talk about a couple who has a combined income of $180,000. We're going to talk about how many properties they buy during their accumulation phase. We're going to talk about their exit strategy, and then we're going to talk about how they're going to set themselves up for a potential early retirement. So if you are someone who's looking to invest in property and looking to see how you can generate passive income through investing, then this video is for you because you will get a lot of ideas from it. So before I get started, let me just tell you the assumptions that I'm going to make. So this couple, their age is 35 years old roughly, and they've got a combined income of $180,000. Their income is rising steadily at 3% per annum, so it's not stagnant. The income is rising over time, and their borrowing capacity, they can borrow up to 6 times their income, which is usually the standard. And they're starting the journey when they're both 35 years old. When they're 40 years old, that means 5 years from now, they get a boost in their income and their combined income jumps to $240,000. At 45, they get promoted and they move into more senior leadership roles and their combined income rises to $350,000. So it's a very realistic scenario, where their income is increasing over time. And we're going to see how many properties they can buy. The first thing I've got to clear first is that they've made up their mind that they can't buy a first home. So at $180,000, they can borrow up to $1.1 million. If they buy a home for, let's say, $1 million, that means they don't have any money to invest in property and their investing journey is going to be put back by about 5 to 10 years. And so they don't want to get into that scenario, and they've decided that they're not going to buy their first home. They're going to rent while they invest in property. So this chart here, the blue line at the bottom shows their income that's rising over time, right? So as I said, it's rising steadily at 3% per annum. Year 5, there is a boost. Again, at year 10, there's a boost, and then it keeps on rising steadily. The orange one shows the borrowing capacity. So that's 6 times their income. So they are going to buy 5 properties over a period of 12 years. So that's the accumulation phase. And all of these properties are going to be purchased in their own names to maximize tax benefits. And the first 2 purchases, in fact, in year 1 is going to be using the deposits they have, and the subsequent purchases are going to be from the equity generated from the properties. So at year 1, they buy 2 $450,000 properties, which means that their combined debt is $810,000. The debt is the gray line over here. At year 5, they buy one $450,000 property, which takes their debt to $1.26 million. Year 10, they buy one $420,000 property, and their debt moves to $1.71 million. And in year 12, they buy one more $450,000 property, and their debt is at $2.21 million. And as you can see, this gray line, which is the debt, that's always below their borrowing capacity line, the orange line, which means that all these purchases they can buy using their income, right? Their income allows them to take on this level of debt. And that's the reason why we are buying properties within that space of time. So there is almost 5 years between the purchases. And the reason for that is because they want to allow their income to rise sufficiently for them to buy more properties. Now let's look at the strategy that they're using. So this table shows here their purchases in year 1, 5, 10, and 12. And it's all going to be a buy and hold strategy. So what does that mean? It means that because they are busy with their work, they just want to buy the properties and let them rise in value. They're not going to do any cosmetic renovation. They're not going for a subdivision strategy or anything like that. It's a very simple buy and hold strategy. And since there is sufficient time between purchases, almost 5 years in each time with their buying properties, they don't have to buy in hotspot markets. They can buy in markets that are moving up slowly and steadily because they have enough of time for these properties to generate equity. So they're going to buy in strong markets, strong diversified economy. They're going to buy in different states around the country to make sure that they have enough diversification, and they're going to make sure that they have 5 to 6% rental yields to make sure that they have good cash flow and they're not too much out of their pocket. Okay, so that's the strategy. Buying in strong markets, but not necessarily in hotspots, but markets that are slowly and steadily moving up in value. Now, let's look at their portfolio position. Now, let's assume that their properties are moving up over the long term. They've moved up by 7% per annum. Okay, so over a 25-year period, the portfolio now becomes $9.1 million. And look at the cash flow chart here. They are in negative territory for quite a bit of time. So until year 18, they're still in negative territory. So they only break even around year 18 or year 19 because I'm still modeling interest rates at 6.50%. And from year 19 onwards, the cash flow becomes positive because rents are increasing. And so the cash flow moves into positive territory. Okay? So by year 25, they're generating 30,000 in income, okay, from these properties. Now, 30,000 by the end of year 25. So they are around 60 years old and they only have 30,000 coming in as passive income. So they want to change that. They want to make sure that they get more passive income. So at year 20, they plan an exit strategy. So what is that exit strategy? They have two approaches to this. Okay. So first one is by selling off properties 1 and 2 and getting passive income from the debt-free properties 3, 4, and 5. So if they do that, they can generate 75,000 per annum in passive income by year 20. Or another approach which they can generate much larger passive income is by selling off the entire residential portfolio. So if they do that, the portfolio value at year 20 is $6.5 million. The remaining debt is $2.1 million. And let's say they sell off the portfolio, they pay capital gains tax, they still have about $3.3 million in cash. And what they can do is they can buy 3 $1 million commercial properties, okay, each with a 7% net yield. So each one of those properties is going to generate 70,000 in passive income per annum. And since they have 3 of these properties which are fully paid off, they can generate 210,000 in passive income from year 20. So you can see how a slow and safe strategy, a low risk strategy over that 20-year period, the wealth it can generate and how you can transition into more cash flow by moving from residential into commercial. Now, there are two of these, both approaches could work. It just depends on how they want to go about it. So that's basically the idea of this video, right? So you could have an average income. It doesn't mean that once you hit that borrowing capacity ceiling, that's the end of your property buying journey. Always take note that your income is rising over time, which means that over time, you still have a chance to accumulate properties. And the real magic happens when you let these properties compound and go up in value. Okay, we're not even going into other structures like trust structures. You can even go into third-tier lenders and do this more aggressively. So this is not an aggressive approach. It's a very simple approach, and see the results that you can generate. If you're patient, if you're willing to wait, there's a lot of money that you can generate in the long term. So the idea of this video is that be patient, be strategic, and then you can build wealth through property. So that's it from me, guys, in this video. I hope you found some value in this. If you like the video, please like and subscribe to the channel, and I'll see you in my next video.